ESG has a brand problem in venture capital. Our companies are building their teams quickly, scaling at multiples a year, and oftentimes pivoting their businesses to match product market fit. I'm Lexi Novitske at Acuity Venture Partners. We care deeply about governance, but we find when we breach the topic of ESG with our companies, we often get very cold reactions. Our founders say, we want our investors to have a commercial mindset. Move fast and break things is our motto. In our experience, investors that have an ESG improvement plan lack the flexibility to understand what's needed in the business today. We avoid investors that have ESG mandates. All those reporting requirements, they just drag us down. But these same founders agree that diversity is important to my business. I care about social good and financial well-being to my customers. Employee retention is the most important thing to scaling my business, and making the best work environment to make my people happy is my first priority. I want to build in systems to make sure there's no financial leakage, corruption, or risk of fraud. Transparency and data in our business is how we make smart decisions. We have to protect our customer data. Trust is our unique value proposition. It sounds like the same metrics that are important to us as investors when talking about ESG is also important to the fast-growing tech founders that we're backing. So how do we bridge this gap? At Acuity, we've been thinking about governance for some time. We don't have all the answers, but we do have a couple of things that's worked for us. Number one, let's talk about ESG in terms of the value creation we're helping support our companies with. Let's call it what it actually is, building a sustainable company that will benefit all stakeholders. ESG isn't the only value that we provide, but it's one of many in a large toolkit. 2, show how systems in place that businesses are already using to understand their current businesses and their customers can be used for ESG and impact reporting. It isn't always necessary to reinvent the wheel. 3, make it clear that not everything has to happen on day one. Depending on the stage of the company, we might even start talking about the basics. How do you think about responsibly growing your company in the future? What might be some of the unintended consequences, and how are you managing these? How are you motivating your employees? 4, talk about the risks of not paying close attention to issues such as harassment, financial controls, good governance, cyber controls, and even regulation. Be able to show the cost and the impact of not being prepared to your companies. Make it clear that they have to be prepared. There is potential for our companies to be the leaders in their markets in shaping consumer protection, for example, rather than being just surprised by reactive policies from the regulators. We saw this earlier this year when several Nigerian fintech companies had the rug pulled out from under them when they were suddenly blocked from accessing the central bank's BVN, a database of unique identifiers for individuals that had bank account. And they did this over data privacy concerns over some bad actors in the fintech landscape. Number 5, make it accessible. Build out some tools that can help your companies with their own ESG. At Acuity, for example, we've built out a learning management system that will help scalably train and measure teams across our businesses on things like diversity and harassment, data privacy, anti-money laundering, and corruption. Eventually, we want this to be available to the entire ecosystem for free. Other accessible tools might be a library of policies like diversity and inclusion plans that you can provide your companies as a resource to get started. Or even better, maybe a modular template that can be produced depending on a company's goals. Having preferred network providers that can easily plug into a company's existing systems, such as financial controls, or help them set up dashboards to track things that really matters, and even connect to existing grievance systems. Number 6, make it fun. Role play, have skits, gamify learning management systems, have debates on blind spots and strategy sessions. Find ways where the entire team wants to engage in these discussions. Number 7, help your companies put together a board with members that will help drive expertise and growth in their business. Founders don't want to have just investors around the table. They want to have people who've built and run businesses that have experienced the same challenges that they have. This goodwill will certainly not only help them grow their business, but help with the ESG plan. Have management buy-in and want. Don't depend on aggressive clauses and deal docs. Over the long term, that just doesn't work. Number 9, have open conversations on how their platform is used and how its data is used responsibly. What does ethical AI, aggressive lending, data privacy mean for their business? What does it mean for their reputation, the mission, geographic expansion, and even their acquisition potential? How does building this goodwill impact their relationships with their customers? Number 10, have role models. Success stories from your own company can tell their story of how reporting and having quality internal policies were drivers of their own long-term commercial value. Or 11, maybe just call it what it is. Building a business that's good for their employees, their customers, and the overall ecosystem. Call it conscious scaling, responsible business, or building something that our founders will be proud of. I mentioned that our founders usually shudder at the first mention of ESG, but we've been down this path with many by working through building better, more sustainable businesses that benefit all their stakeholders. Might sound corny, but let's make ESG cool again.